All right, guys. So I thought it'd be an interesting idea to kick off our workshop sessions with how to approach trading earnings, primarily because Salesforce reports this evening. So I want to go through the way that I think about it and how I approach it, like soup to nuts. I haven't prepared anything in advance. This is how I approach it every single time I look at an earning report or a potential earning play. So the first thing that I want to look at typically is I want to look at the straddle price on a given asset, right? So start off number one, straddle price. And why? Because it provides you uh, with the implied move on the earning report. This tells you how much the market expects a given asset to move by a given expiration date. So looking at Salesforce right now, I'm going to pull up the option chain on Salesforce CRM. Hey, Blockproof, your mic's open, by the way. So if we price out the straddle right now on Salesforce, same expiration, so nearest expiration date, which is this Friday, the combined cost of the at the money calls and puts are about $16 overall. So that tells us that the market expects that Salesforce will move plus minus 16 points from the current price. So now we have our CRM straddle, which equals plus minus 16 points. Now spot price is 180, which means that upper implied move is 196 and lower implied move is 164. So you have metrics now to operate with because we know what to expect. So when we pull up the chart now on Salesforce, we look at what the chart is doing, we can draw some lines now. We can say, okay, well, we know that the lower implied move is somewhere over here, right to the lows, the recent lows, 164 area. And the upper implied move is to 196. And I usually put in some commentary here, right? Upper implied move, 196 over here. And then the lower implied move over here is to 164. Now, given that it's traded as low as 164, this would be a great area to go long naturally, right? If we pull back, assuming that the report was decent, this would be a great spot to go long. If we break to the upside, obviously, it makes it for a less asymmetric position if we're already pushing $200 plus, because naturally the market will have rewarded the share price to the upside already, factoring in some good news. But you got to think about what your bias is over here, right? Like we're kind of in the middle of where the lows are recently, as well as the recent highs. Recent highs are like 193, and the recent lows are 164 or so. So we're kind of in no man's land, which doesn't really tell me a lot of information as to like my directional bias overall. Like fundamentally speaking, so there's questions here. Mike, can you hear me right now? Yeah, hopefully everyone can hear me, I guess. But fundamentally speaking, Salesforce is pretty sound. Like historically, from memory, they trade typically at around like a 15x multiple on sales. And right now, looking at their fundamentals, excuse me. So they're currently trading at a forward PE right now of 3.57. I'll share my screen with you guys too, just so you can see what I'm looking at as well. This is a very holistic approach to looking at earnings. So you can see the forward PE is 12. and the price of sales is 3.57. Now, historically, it's been about 3 to 4 times what it is right here. So the valuation is actually pretty cheap at the current price. Now, obviously, we know that SaaS names have been beat up heavily because of the hyperbolic narrative that AI is going to replace every single company because every Tom, Dick, and Harry can essentially vibe code their own version of Salesforce. Now, part of the problem with that narrative is that they don't have the data, they don't have the help desk, the support, the sales team, right? If something goes wrong, how do you fix that? Anyways, I'm not going to delve into that topic overall. We're going to talk about earnings and how to trade earnings. So, from a perspective of like fundamentals, I like this as a long-term position. And trading the short-term, like the 1 week out expiration, so for Friday, for example, typically is not the best way to think about positioning yourself because oftentimes what will happen is that we might get, a positive report or a negative report where we don't move at all, essentially. And when that happens, you essentially get burned on whatever position you take for the Friday expiration of that earnings event. So you can trade it short term if you want to. That's an option, obviously. But more often than not, you're better off looking at longer term or midterm expressions of your overall thesis. This way, you're not going to get a zero up position. Someone's mic's open right now. I'm not sure whose mic it is. Let me see. Maybe just mute everyone right now. How do I mute everyone? Dispense. No, it's fine. So the point being is that you want to look at perhaps a mid to longer term position. But if you are looking at the weekly expiration, expect that whatever you put in can go to zero very quickly. So you need to pretty much be willing to take that risk, and whatever risk you take, you need to be okay with it going to zero. So looking at it from a bullish perspective or a bearish perspective, if we're looking at it from a bullish perspective, we're thinking perhaps that CRM has a push to the upside to like 196, for example, tags that 200 area, which has been resistance over the past few months. And then assuming the report is very positive, it's possible we push back up toward the 230 area and try and gap fill that, but it might take us some time. Because if you change this from a daily chart to a weekly chart instead and analyze the weekly expirations, or the weekly ranges rather, you can see that it takes us a fair amount of time about from a peak to a trough, takes us about, what is this, almost 2 months from peak to a trough. We don't really have a lot of troughs and peaks to look at over the last year or so. But we have seen, I guess, one instance over here where we went from 221 to 270 almost in the span of 4 weeks. So you want to probably think about going out at least a month if you're going to express this with a longer term perspective. Now, let's look at some different ways to trade this, right? So now we have our straddle. The next thing we want to look at, obviously, is our directional bias, right? So there we go. You know what? I'll just make a new box here. So next thing is copy, paste that. So I guess my computer's lagging a bit here. So the next thing is directional bias. Are we bullish or bearish or neutral? In this case, I'm more inclined to go against the trend essentially right now and say I'm bullish, just for argument's sake. And given this bias, again, you could be bearish. It doesn't really matter. The whole idea here is use it as an example. I'm not saying to do what we talk about. I'm just using it as a framework to think about earnings going forward and how to position yourself into a binary event. Now, if you're already positioned in Salesforce, there are many ways you can obviously trade this. If you have a stock, for example, and you want to hedge yourself, kind of like the way we discussed the positioning last week on NVIDIA, there's a similar way you can trade Salesforce, which is using something called a calendar collar, essentially, right? Now, what is that? That's where you look at the positioning for a few months out, perhaps. Let's say you own shares right now at like 180 and you're worried about downside. So what you could do is you could, for example, it's running really slow right now. You guys can probably see this lag as well. Um, you could, for example, sell like the August or September OPEX out of the money call options to finance the weekly put options against your stock. So let's go to September, for example, right? Now, right now you get at the, sorry guys, it's a bit laggy right now. At the 200 strike, you get 1280 roughly. That's too close to the current price because obviously if it shoots up, you want to have, some upside, not just capped upside with some shares. But let's say you go, for example, for the 240 strikes for September, which is 114 days away, you're getting about $5 credit over here. Now, the weekly OPEX, which is 2 days from now, the at the monies are about $8. Out of the monies by $5 are about 550 roughly. So, for example, you could sell those contracts for September at the 230 strike or the 240 strike, for example. Let's say the 230 strike for argument's sake, for about $5.60 or 570 roughly. Take that credit and apply it to buy your insurance through the binary event, which is tonight, obviously. And you would buy the 175s, for example, for roughly the same price. Basically, you have $4 of downside on your stock while you still have upside of $50 into September. Now, if it plummets like 165, for example, or 160, for example, what happens? Well, your shares obviously are down by about $15. Your put option here, which is about 570, which you paid for with your credit from the calls sold for September at the 230 strikes, are now trading probably for around like $12, $13 overall. At that point in time, you're going to monetize them because naturally speaking, they expire on Friday. And unless you want to lose your shares, you're not going to let them um, put your shares on someone else, right? For those of you who don't know, a put option is called a put option because it gives you the right to put your stock on someone else, right? You might be wondering like where the term puts or calls come from, right? And vice versa. Or the opposite of that is a call option, which calls your stock away from someone else, right? So back in the day when when you're using phones to call your broker, you say, "Hey Bobby, I'm putting my stock on you because with my puts, or I'm calling my stock away from you, my calls," right? That's how the puts and calls work essentially. So that could be a good way of hedging yourself with stock. Now, if you're like me, you're more risk averse, and you're probably going to think about maybe waiting until after the binary event to pass by, because as you can see, the IV is 58.4%, and the historical for the past year is 49%. And if you look at the IV for this week as well, the current IV for this week for Friday is 140%, meaning that after the binary event of earnings passes by, what will happen naturally is that IV will crush down. And if we don't get a big enough movement, which the current straddle price reflects, what will happen is that all options across the board will lose value essentially. So out of the money options, at the money options, in the money options, they'll all lose value. Now, obviously, in the money options can lose so much value because they have an intrinsic component to them, meaning that they have a true value to them based upon the current price relative to the spot price. So now, like if I'm bullish and I'm thinking about how to play this, for Friday, for example, let's go with a short-term trade, a mid-term trade, and a long-term position. Okay, from a bullish perspective, I won't go through the bearish side as well because you can just do the opposite of what I'm talking about. So if I say, for example, a butterfly call spread for Friday, if you're bearish instead, use a butterfly put spread. If I'm talking about a risk reversal for like September, for example, expressing a bullish thesis over the next 4 months, if you're bearish, express the opposite of that, obviously, right? So that's kind of the way you want to think about this, right? So looking at the Friday OPEX, if we, for example, look at the implied move to the upside, 196. So what's the best way to play that, right? If I buy the at the money call options for $7 a piece and we run to 196, I make about $9 of profit roughly, 850 of profit. Now that's pretty good overall, 100% return. Nothing to really be sad about there. But you're risking one to make one. and it has to move by at least $7 to the upside and change just for you to break even on this position in 2 days. If, for example, we get some positive news and the stock price is flat, which has happened before, what'll happen is your call options will just decrease in value. They might expire by Friday, almost worthless. And then maybe next week or the week following, we'll see a push to the upside. That's kind of what happens when you think about the psychology behind why a given name has a delayed reaction on a move. It's because it takes a while for the information to disseminate across the finance industry into the right minds and therefore the right hands to click and make orders to buy or sell a given asset, right? So an earning report might come out, and then over the next week or so, people will discuss it and come to a consensus on what they think it means. Is this a pivot back to the upside? Is this telling us that SaaS is dead and we should sell our positions, right? That's kind of the way you want to think about it overall, on a like mid to longer term horizon beyond just Friday. Because Friday, we might get, for example, a very positive report where they beat EPS, they raise guidance, whatever. Maybe Benioff's very, very bullish. Well, what happens? Stock price remains muted. You had a bullish position for Friday, you lost, right? Now, you want to find an asymmetric position to play. What does that mean? That means a small amount of risk relative to the amount of upside you have on a given position. Now, let's say, for example, that I wanted to, sorry, my thing is frozen right now. Let's say that I wanted to play a call spread instead, right? If I think that we're actually going to push to 196, would a good expression be perhaps to buy the 190 call option and sell the $200 call option for about $2? The net debit here would be about $2 of risk to make $8 of upside. Now, would you be okay with losing, for example, $200 if you're incorrect? The question you need to ask yourself all the time is, and I'll go back over here again, right, to the free-form chart. Next question is, naturally, 3, what am I willing to accept in terms of a loss, and what must I be compensated for? So you guys might, I guess with the Zoom open and Discord and IBKR is a huge, huge ram hog, but usually doesn't feel this bad right now. Compensated for in exchange for taking such a risk. Right? So basically, like, what am I willing to lose, and what kind of upside do I have to have in order to take that risk? Oftentimes, people will just buy call options or put options, not thinking about like, oh, I'm risking $8 to make maybe $1 or $2, right? Is that a great way to trade it on a long time horizon? Remember, think about repeatability across your trading career, investing career, right? On a long time horizon, if you take for asymmetric upside trades, you're going to come out negative. The expected value there is negative unequivocally, right? Because no given winner can erase a slew of losses, but a given loss can erase many, many winners, right? So in this case, going back to the option chain, I'm looking at, a bullish play. I might look at, for Friday, the 190, 200, 210 butterfly call spreads. Sorry, guys, my option chain is super slow right now. Anyways, I'll keep my ideas flowing regardless. But so the cost of the 190 is $4 approximately. The cost of the 200 is about 185, which you'd be selling 2 of those. And the cost of the 210 is about 75 cents. So if we buy this, sell 2 of these at 200, and buy 1 of the 210s, the overall cost right now is approximately $1.20 risk for maximum upside of $8.80. So you have basically almost 8x upside for your downside overall, or 8-to-1 reward to risk ratio. Now that is a very, very desirable position to take, because on a long time horizon, pardon my cough, on a long time horizon, if you take similar trades like that, your losses will be minute, whereas your winners will offset your losses by a wide margin. I had one student yesterday talk to me about Micron and how his gains on Micron alone have erased all of his losses over the past like 3 years. And he's like amazed by that. And I said, well, yeah, I mean, like that's the beauty of asymmetry of risk, right? When a position plays out for you and you actually hold it to fruition, you can see gains that are beyond your wildest dreams. John Claude, your mic just went off for a sec on an order fill. So that's kind of how I would position for a short-term play. And the way we can look at that is, where's a chart that I had up for Salesforce? Let's pull the chart again. So, I guess bear with me one sec. So looking at the same chart again, let's go back to daily. I guess John Claude's doing some serious trading right now. But the point is that if you were to, for example, buy this 190 strike, sell this 200 strike over here, and then buy the 210. So you're buying one of these, selling two of these, the middle strike for a butterfly, and you are buying one of these. Basically, a butterfly, for those of you guys that aren't familiar, I'm sure most of you guys are, obviously. It's one of my favorite strategies because you're net selling options essentially, right? You're selling two of the middle strike options, which have the highest amount of premium typically, like across your whole position, and you're buying one out of the money option to kind of hedge the risk that it overshoots those middle strikes. You're essentially combining a call spread 190 to 200, which would cost you normally $2, with a credit call spread 200 to 210, which gives you a credit of about 80 cents. Instead of risking $2 to make 8, you're risking 120 to make, 880. Now there is a risk that it perhaps overshoots and goes past 210, in which case that's an equally bad outcome to it staying below 190. Because if it goes to like 220, for example, what happens, right? Well, your 190 is worth $30, but your 200s are each worth negative $20 a piece. That's minus 20 times 2, which is minus 40, plus the 30 is negative 10. And then your 210 is worth $10 positive. So net you're at zero, but you have a debit of 120. So overall, you're going to lose the debit amount, right? If you're lucky enough, what happens perhaps is if it overshoots and the 190-200s trade for almost pure full value of almost $10, what one could do is one could close that position out, hope for a reversion back toward 200 over the next day or so into Friday, and then buy it back opportunistically when it pulls back down toward 200, right? But ideally, what happens is that we push like 196. Come Friday, we're at like 200, like 202 or 201 or like 198. You don't really aim for maximum profit, but the idea that you should have via risk management is whatever position you take, when it doubles in value, you cut half. That is a strict rule that I have, and it pretty much removes all emotion from decision making. You're like, you know what? I have a good setup right here. I take a trade. It goes in my favor. We doubled in value. I cut half. Now I can ride the rest of the position to fruition because I have no emotional attachment to it whatsoever. No matter what, I cannot lose. And so what happens is that you just hang on to it. You're like, whatever happens, happens. Maybe it goes from like 120 to like $3, right? You cut half, you have a guaranteed profit. Then you have to hold it over Thursday night, which may elicit perhaps an adverse reaction on Friday, where we have PCE release in the morning, which might cause a large move to the upside or downside, perhaps, right? And so I don't really care what happens. Again, I've said it numerous times to those of you guys that are newer in the group, but the objective in trading should not be to maximize your profits. It should be to minimize your overall emotional attachment to the position, or said another way, maximize your indifference as to the outcome overall. Like if I lose, so what? Who cares? I was wrong, move on to the next trade. Because over time, as long as you're making or you have a good decision-making framework where you're choosing good positions with asymmetric upside and you're managing your risk consistently overall, that's where your edge will reside. John Paul, your mic keeps on popping off on the order fills. There you are. I'll just mute you. All good. So that's a short-term expression of a bullish thesis, for example. Like a butterfly call spread. Could you go wider in wings? Sure. Is there a reason to? Probably not, given that you're going out of the money here. You're going out of the money such that the implied move to the upside of 196, it targets pretty much the exact area where you want it to land. In that, if we land at 196 by Friday, you're going to be happy because your 120 will be worth now $6, obviously, right? That'll be a gain of 400% on your overall risk, which is phenomenal. Now, obviously, it's a very, very short-term trade because it's Friday. Would you allocate a heavy amount of capital to this position? Absolutely not. Like I always say, the more time you have on a position, the more you can risk because you have more time to be correct and more time to adjust as well. Whereas a binary outcome of a 0-day position or 2 days out position does not elicit enough opportunity to de-risk your position or to perhaps stop loss out where you can, take an acceptable loss. So basically, whatever you put in for a Friday position, you need to be okay with that going to zero, right? Um, yeah, I'm just reading the questions right now, guys. What a trader. Um, we're trading during lunch hour, Iron Pop. Yeah, what is Iron doing right now? I'm not even following Iron. It's popping off. Nice. Beautiful move on Iron. Anyways, I'll keep it to the Salesforce conversation regardless. So again, if you're bearish, you can do the opposite position. You can, for example, say like, 170, 160, 150 put flies, similar outlay, similar upside, similar expression of the trade overall, and similar management of your overall risk. Now, if we're looking at a midterm position, like let's say, a few weeks out perhaps, or maybe a few months out, that's kind of a more interesting approach because you can allocate more capital to that. You have higher conviction. You have more opportunity to actually de-risk your position if and when it comes to fruition. Again, it really depends on your overall thesis. But in this case, on a midterm time frame, you'd be targeting probably somewhere around 200 and up to that gap fill of 230. That could happen in the next like 3 months, for example, right? So if you were bullish to let's say like 230 over the next, 3 months, how would you express that kind of a position? And again, the opposite of this, if you're bearish, just think about what I'm saying from a bearish perspective, right? I'm not going to go over both sides because for time's sake, we're already half an hour in, right? But let's say we want to go out for an expiration date. Look at the IV right here for Friday. It's insane. As we go past Friday, the IV drops off heavily. Each week, each subsequent week will drop the IV off by a fair amount. The reason being is that everyone who's trading the earnings event in the market, every market participant is trading the shortest duration typically, which is why you get this massive activity around the short duration options, right? As you go further and further out, like no one's buying, for example, June 12th. It's a very obscure date. It's not monthly OPEX. It's 2 weeks away. There's not much activity over here. But like for Friday, for Friday today, you have like thousands of contracts traded across the board, 70,000 volume overall. You go to the June OPEX, you might have a bit more activity over here as well. So you might have like, for example, the 190s here are trading, 1,000 and change contracts, like 1,454 contracts have traded already today for the June OPEX. But let's assume that we're going to take about 3 months of time from now until the next earning report for a move to occur. And if we get a move to the upside, it'll have some follow through for us. So we're going to look at, let's say, the July OPEX. That's 51 days away. August is 86 days away. I like August because it's 3 months away. It's nice and clean. The IV is low. Like looking at the IV here, 48.3% versus the historical volatility of 49%. You're paying lower than average volatility, which is what you want. You don't want to be paying excessive fees. Think about it like buying car insurance, right? Like, or a better metaphor is hurricane insurance, right? If you have a condo in Florida, for example, South Florida, and you buy hurricane insurance like in August or September when the hurricanes are hitting, you're going to pay a crazy premium. Versus if you buy in December when the probability of hurricane hitting is nil, you're going to pay a much, much lower premium, assuming that you can buy insurance for a shorter duration period of time, not an entire year, right? But the point being that here is that, okay, what is the implied move by August, right? Same exact thought process. 180 strike, 1650 and change for the call and the put. Basically, the market's telling us that by August, we expect Salesforce to move up or down by about $33 in one direction. So up to, for example, 313 or down to 147. or so, right? Now, are they doing bad enough to justify a move to the downside? Here's the thing, and I want you guys to look at this, which is kind of interesting, right? If I look at the competitors to Salesforce, where is it? Here it is, right? So if we go to software applications over here, come on, open. And I look at the performance of these companies. I want to look at also companies that are of the same size, between 10 billion and 200 billion. So we only have, about, what is it, like 40 companies or something like that? 28 companies of the same size. Over the last year or year-to-date performance, for example, right? You can see that almost every company in the sector has been decimated. Like Intuit's down 53%, HubSpot 49%, Atlassian 45%, so on and so forth. The only performers, goddamn ads. So get it when you use a free version of Finbiz. You can see the only performers here really are Datadog, Cadence Design Systems, Zoom Technologies, Strategy Inc., and you have MSTR, which is not even a proper SaaS company, right? So you basically have like four companies that have performed well in this sector. One of which is Zoom, who holds a large stake in Anthropic, and then you have Datadog and Cadence, right? So what this expresses to me is that overwhelmingly the market is ultimately very bearish on SaaS. Now remember, a bad investment, a bad company can be a great investment at the right price. A great company can be a bad investment at the wrong price. And so this is kind of where you are looking for opportunities in the market, where when a name is beat to crap and left for dead, any modicum of positive news can elicit a massive recovery in that stock price. We've seen it happen many, many times. Like in the solar space, for example, there was sorry, my mom's calling me. Just call her back. Enphase, for example, right? A solar company, they were beat to crap. And look at their current chart right now, if this loads. Pardon my lag here, guys. It's kind of funny. It doesn't lag at all, except for when I'm on Zoom. But you can see right here, guys, so they were at $30 a share in end of April, essentially. They've more than doubled in a month, basically, right? This stock was left for dead, essentially. And the pivot in narrative, well, the pivot here is that obviously AI build out requires energy, and solar naturally is a great way to convey that overall energy build out. Therefore, names like Enphase and SolarEdge and the TAN ATF and First Solar are great ideas on how to express that overall. But the point being is that no one wanted this stock at all. And then all of a sudden they did want it, right? So a similar narrative can occur with Salesforce. I'm not saying it will. I'm just giving you the thought process behind how to think about a given position. Now, when the report comes out, naturally you want to look at the price action. What does it do? It could whip around for a fair bit. Typically, you need to wait till after the conference call to see what happens with the actual true price action and price discovery the following day. But you want to look at and see what is the overall trend, right? Like, are they forecasting higher than expected EPS than they were for last quarter, right? Is their guidance very rosy? How does Benioff sound, for example, right? It doesn't matter if it's Benioff or whatever CEO you're listening to. You want to look at cues and be like, okay, well, am I confident in what they're saying, or am I kind of seeing apprehensiveness in what they're saying, and perhaps they're not as confident going forward, which might give me pause to buy this name or maybe move on elsewhere, right? Ultimately, we all have limited amounts of capital to allocate, and that capital should be allocated efficiently in names that you believe in. You need to have conviction, otherwise you can't hold long term. Regardless, let me go back to some questions here. Or I'm going to go back to the chart first. This thing is laggy today. Having everything open, I guess. Let me see what questions you guys have right now so far. Chris said, why not consider broken wings if you have a directional bias? Open for a debit. So they out of the money. He likes them because they remove the overshoot problem. Yeah. So Chris, you could use a broken wing fly for sure, right? You might, for example, do like 190, 200, 205 as an example, right? And your debit might go up from like 120 to like 160 or something like that. It's not a big deal overall. Sebastian says for a bullish earnings play, is the 210 call fly 20 wide, like 190, 210, 230 for June 5th for about 290 too aggressive given the implied move? I mean, not really. Eh? Like that gives you 7 days versus just 2 days to expiration. So he asked about the June OPEX fly versus June 5th OPEX fly versus this coming Friday, which is May 29th. So you could buy an extra week of time, perhaps go a bit wider. And yes, I mean, the thought process there would be that if they have a bullish report and they go to like 196, they'll probably keep on trending to the upside toward that 210 strike, perhaps by next Friday, Sebastian. Yeah. So that's a great way of thinking about it for sure. Again, it all comes down to really what your desired risk is and what your desired reward is overall. Um, Parag asked about something totally off topic, which is the reading on MU. It's been flying high. Yeah, Parag, I mean, their valuation is still very low. Like the forward PE multiple right now on Micron is only 9 right now. The problem with, and the reason why Micron historically has remained at a muted price, like looking at the chart on Micron here, right? So look at the longer term time horizon. Like let's go out 10 years weekly, for example. You can see that, and I traded this for a long time. You can see that it had its peaks and then its valleys and then its peaks and its valleys over time. It didn't really do too much at all. The reason being is that memory is perceived as a commodity asset, kind of like oil essentially, but for computers essentially, right? And for most of the last, 10 years roughly, and for I guess the last 20 years roughly, typically you have peaks and you have valleys in demand for RAM. And given that there's an oligopoly behind these names, there's SK Hynix, Samsung, and Micron that make RAM, especially HBM, high bandwidth memory. These companies have traded like in very very narrow ranges because they're based upon cycles typically. Now, what's happened here from last October was that when they reported earnings last October, it was over here, I think, somewhere over here. They changed their guidance drastically to the upside. So, like I showed you guys this morning in the morning meeting, what their earnings were for the past few years. Their pivot, like their forward multiples are insane. Like just for you guys to look at. One second, look at my phone so it doesn't lag at all. So here's kind of what you guys can think about looking at, right? For last year, each quarter, okay, Q1, they made 179 for that quarter. Q2, 156. Q3, 191. Q4, 303. Q1 this year already, 478. Q2, $12.20. Q3, almost $20 expected for Q3. Q4, almost $24 expected for Q4. Next year, you have $26, $27, $27, $28 per quarter. So you're going from $1.79 per quarter last year to forward guidance of $27 per quarter. So think about that, right? Like more than a tenfold increase in earnings per share. Naturally, the stock price goes up, what? 10x, right? And that's kind of why I had such high conviction on Micron back when it was sitting in this little pocket right here back in December. I told you guys to buy this, back when it was like 240, 250 a share. And we're up like, almost 4x right now from that bottom on stock alone. Again, these opportunities don't come about very often where they're that apparent, but when they do appear, you got to pounce and act on them right then and there. If you wait and hem and haw, you're probably going to miss out on the opportunity overall. Anyways, guys, we're running 40 minutes here. I have positions open that I want to look at, but I'm going to save 10 minutes here for Q&A. Any more questions, guys, at all before we break off? My pleasure, Parag. Yeah. And by the way, guys, any criticism about this process, again, we're going to do these once a week going forward, different topics. And you guys can tell me what you want to discuss, perhaps. Honestly, like I've written a course on option trading, which is 120 pages long. I can literally write, about the markets and probably write 1,000+ page book on the markets I've written articles on different topics. Whatever you guys want to discuss, I'm happy to talk about. The thing is, it's what's important to you guys to look at, right? How do you want to perceive the markets? How do you want to change your perspective such that it gives you, perhaps a little bit more of an edge and how you operate and make better decisions, perhaps? Like ultimately, it comes down to, like your decision making process. When it comes down to it, like you're sitting in your chair, you're pulling up your terminal, you're putting in your orders and clicking a mouse. That's just like your physical process overall. What is your mental process around how do I decide what to do, when, and why? How much do I allocate? When do I take profit, right? A lot of these topics are really, really important to think about, but most people have no purview into that mental process because they haven't really been introspective at all. Yeah, my mom's calling me again, so maybe I'll call her back after that. But next one from Parag said, how to analyze PE ratios. Sure, yeah, we can discuss that if you want. Michael asks, I assume during some regimes you prefer to take some structures over others. What is your process in looking at the surface that skews your willingness to take on flies, leaving it vague/open? So the process there is that, for example, like look at SPX, okay? Whenever SPX is trading near a high, that's not the right asset. SPX, here it is. Whenever we're near a high like this, there are certain strategies that you don't want to use, and just by process of elimination, you kind of say, okay, well, what do I not want to use, right? Like, do I want to be selling put options here at the money? No. Do I want to be selling leaps put options at the money on most of these names that are like already high flying? No. Therefore, I'm not using risk reversals or variations of risk reversals. Whereas at a low, when a name is beat to crap and left for dead, I'm more than happy to sell cash secure puts on names like Nvidia and Google and Microsoft because they elicit, for one, a ton of premium, because when we decline to the downside, um, IV spikes, giving us more premium on the put options. So, like, for example, when Nvidia was trading back at like 165 during the market lows, you could sell the 140, 130, 120 puts for January and pull in like $15, $13, $12, basically saying to yourself, okay, either I'm going to collect about 10% return on my risk overall in the next year, or I'm going to be forced to own Nvidia at a price that is about 20% below the current price. And if you look at their 4P multiple, like at the lows, they were at a 4P of like 14-ish. Basically, what you're saying is I don't mind owning them at a 4P of like 11 and a half or 12. So like the probability of you losing money there is almost nil, barring some catastrophe in broad markets where there's a endogenous risk event, like where the financial system is collapsing or whatever, something like that. So you want to use perhaps more cautious strategies here, like call spreads, maybe not such long duration, because again, buying leaps right now doesn't make much sense. If you have a pullback at some point in time, then you want to deploy capital to longer term positioning. But thinking about it from the perspective now that we're so overextended from the bottom, like we're up right now, almost 20% in like in like 2 months roughly. Even from the prior high, we're up 7.5%, right? So you don't want to be using long-term positions pretty much at this juncture right now on names that are already at highs. Names like Microsoft, Meta, Nvidia, yeah, go wild because they're not trading at highs and they aren't very frothy. What will happen is that if and when this market gets a correction, cash will rotate out of like the semis into names that are beat up, like Meta and Microsoft, because they're safe, cash generating assets that are trading at low multiples. Hopefully that helps, guys. Let's see. Where were we here? PJD asks, where and what's your options book? So it's not my options book. I teach and mentor people one-on-one through my own process. My website is optionfinity.com. But I'm currently fully booked until September right now. So if anyone's interested in working with me one-on-one, hit me up, DM me, whatever. Happy to talk about it. But that material is for the course itself overall. You can buy it on its own if you want to. It's a self-study course, but if you're not very well versed in options, you're probably better off talking to me one-on-one and discussing your overall objectives. I'll tell you what I think is the best course of action going forward. Damian Brown says, thank you very much. Awesome, Damian. My pleasure. Kevin said, what guidance do you use to determine whether to look at the actual earnings play, CRM, versus playing option in the same space, i.e., like ServiceNow? Yeah. So, Kevin, what you're discussing is called a sympathetic trade, right? Where the probability is that like Microsoft, ServiceNow, HubSpot will all move based upon what Salesforce says, essentially. And that's a great question and a great way to play earnings. You could, for example, take a position on ServiceNow because the probability is that if Salesforce is up like, 10% tomorrow, for example, or like 5%, the probability is that ServiceNow is up like 3 or 4%. So an at the money, five wide call spread, perhaps if you're bullish, or five wide put spread if you're bearish, is not a terrible way to convey a sympathetic trade on a given name that you're interested in trading, for example. And Andre said, "Can you please repeat? Is it worth waiting to the earning report before entering the middle term position?" I mean, it doesn't really matter so much. The key thing is that if you get an upside move of like 10-20% off the open tomorrow, what'll happen is like the call premiums will explode across the option chain, because what'll happen is that everyone and their brother is going to be chasing those call options given the narrative pivot on Salesforce. And if we see a huge push to the upside, it's not too late yet, but it means that your asymmetry of risk isn't as great because you're paying a higher premium for the options after they've already exploded. The better thing to do is, if you're concerned about perhaps an adverse reaction to earnings, take a small position where you have some skin in the game, but you're okay with losing that money. So like, let's say for example you want to allocate maybe like 5% of your portfolio to a longer term position. Maybe you do like 1% allocation on a midterm play. If you're correct, you're still partaking in the upside. If you're incorrect, then you can perhaps allocate more capital at a much lower price where you have better asymmetry of risk, right? So again, like you need some risk to get reward. That's the name of the game. You can't have no risk to make reward typically. I mean, you can use put ratios on SOXL, and if you have a zero debit cost, like those are kind of like not free money, but somewhat free money in my mind anyway. Yes, this is all recorded as well, PJD. I'm going to post it as well for you guys to watch it again. Yep, I recorded it. Nino, no problem at all, man. I will see you tomorrow as well, Nino. And Andre, what do you usually look at when designing a diagonal counter trade? So usually I look at the implied move and where we're going to land after the earning event or the binary event, because the straddle is telling us where we're probably going to move to, right? If I look at, for example, Salesforce again, as I said, that lower line was over here was the when I had it over here, one sec. It was over here, 164. So this line is a lower implied move. This line over here, right at 196, is the upper implied move. And so building this butterfly around that upper implied move, it captures it. Think of it kind of like a net around the butterfly. The implied move to the upside, right? You're trying to catch that butterfly right here where it lands in the middle between like 190 and 200. And again, the beautiful thing about it is that your risk is so minute. It's $1.20. If you're incorrect and you allocate a small amount of capital, it's not a big deal. Like if you lose it, like, whatever, who cares, right? That's the mentality you should have is I don't get upset when I lose. I move on to the next trade, right? Zero emotion, right? The problem with most people is they're going, they're very gung-ho about positioning. Like my cousin's friend, he's in his early 20s, he was saying like, I have to take a minimum 10 lot position in order for it to be worth my while. I'm like, why 10 lot? Like he only has like 7K in his trading account. I'm like, so you're telling me that you're putting like most of your account into every trade that you take? He's like, yeah. I'm like, that's stupid though, because you can take like, one or two lots where you're risking like $200, for example. If you're correct, now that $200 is worth like $1,200. You just increase your portfolio size by like 12% on risk of like, what, like 4%? That's a pretty nice way to convey your upside. And if you lose, you're not very upset overall, right? You got to think about your psychology behind everything too. Like we'll discuss psychology at some point as well, but it's a very in-depth topic. We're already 50 minutes in, guys. What other questions we got here? Let's see. Do I ever sell vol? Yeah. So ICs, I do love ICs. I also love iron butterflies. Like, what you could do perhaps is, let's say that you were neutral on this week earnings. You could use an iron butterfly, sell the straddle, the 180 straddle on CRM, buy the wings, like buy, for example, the 190 call and the 170 call. The credit you're going to get there is like, let me see. The credit you get is it's 16 minus like 350 and minus 4, so minus like 8 roughly. You're going to get $8 credit on $2 of risk overall. So as long as Salesforce stays between like 172 and 188, you win. It's not a bad way to play it. I mean, again, like you're risking 2 to make 8 if it doesn't move at all. So what you could do is you could pair that kind of trade, for example, with like a butterfly trade, kind of like Sebastian mentioned for like next week, the 190, 210, 230, for example, where if we stay tight in this range for Friday, you might make like $2 or $3 or $4 in credit on the iron butterfly, right? And then you still have a position for next week, which would then be free. Obviously, if you got paid off on that iron butterfly, where it could possibly go to like, from 185 to like, I don't know, 200 to 205 or something like that. These names move pretty abruptly on new information, essentially, right? So once price action changes to the upside, and we had to pivot from like support areas. Like think about a support area as well, right? Support areas, a price area. Think about like house prices, for example, right? Think about like a neighborhood where a new development comes in, people buy houses for like 500 grand. That is a support area. No one wants to sell below that area. Think about Salesforce recently. The price action has remained essentially above 163. Therefore, the probability of us going below there is not very high. I mean, sport's pretty strong here right now, but if we get a terrible print, on earnings, like they miss EPS, they lower guidance, revenues are not as expected. Benioff sounds bearish, perhaps, whatever, right? The stock price could crater down to like 150. Do I think it's going to happen? Absolutely not. I'm more bullish on Salesforce than I am bearish, but it's a possibility as well, right? So like back to the housing metaphor, if everyone buys houses for 500 grand, probability is that no one's going to sell a house for less than 500 grand, right? So that would be kind of like buying houses right here where support area is at the bottom. As it moves higher, someone might sell a house for like 190, for example. Now what's happening is that someone is price anchoring their price to 190. They want to sell it for 190 or above, right? It's all psychology, right? So anyways, guys, we're pushing an hour mark right now. Let me get through the last questions and then I'll break off, all right? If you have any questions at all, by the way, on your own, just DM me as well or put them in chat. I'll respond pretty fast. Yeah, so selling vol, LJ, you asked that about selling vol. You could do ICs, a month out, for example. But the thing is that the payoff is very slow. The asymmetry of risk is not very good overall. I prefer to trade high asymmetry of risk positions into a binary event. If the IV is so elevated that I can get, like $5 credit on a $10 wide out of the money, way out of the money on both sides, not a bad way to play a given thesis. But again, it's a very, very slow game because even after tomorrow, you won't be anywhere near maximum profit. You might maybe sell for $5 credit on a $10 wide iron condor. Maybe you're up like $2, for example, right? Does that excite me? Does it move the needle in my portfolio? Probably not, right? Michael said, "Sorry, my feed lagged, but you said look to sell the center strike that's near the upper limit, the implied move." Yes. So you want to have it so that the implied move, like Michael, on my chart right here, the implied move is 196 over here. This is the implied move right here. You want to have it such that the middle strike is above the targeted implied move. This way, if we overshoot by a little bit, let's say we go to like 203 or 204, you still win, right? You still win. If you go out of the money too far, then the probability of you making a profit is not very high, right? Hope that helps. And lastly, we have, that was just, thank you overall. Listen, guys, it's been almost an hour. My pleasure. I'll post the replay in chat as well. And every week we'll be doing similar kind of workshops for about an hour roughly every Tuesday at noon. If you have any ideas on what you want to discuss at all, hit me up, shoot me a DM, give me talking points. I can talk about anything pretty much. Like it's like whatever, right? So have a great day, guys. Manage your risk well, and we will talk in Discord. Take care.